Isn't it interesting how a single person's small actions from their own room can lead to a situation that makes headlines all around the world? That's exactly what happened with the famous 2010 flash crash that sent shockwaves to the stock market for about 36 minutes. The fascinating part of this crash is that it all started with a little-known UK Indian trader.
We're down over 16%.
Dow at the same time has fallen about 18%. The stock market is now down 21%.
What the heck is going on down here? I don't know.
Because we're now down 43%.
What in the world is happening on Wall Street?
2-year no yields went from 190 to 166 in the blink of an eye.
The NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987.
This is the story of Navinder Sarao, famously known as the Hound of Hounslow, the guy who managed to outsmart Wall Street right from his parents' house. Let's get the full picture. In the finance world, legends can come from unexpected places. Nav, the enigmatic day trader, is one such legend known for his quick rise to fame and fortune, all while operating from his bedroom in his parents' house. On May 6, 2010, the world's largest financial markets went through 15 minutes of absolute chaos that sent shockwaves through the financial world. Suddenly and without warning, both the U.S. stock market and futures market plummeted, erasing $1 trillion from the value of American companies in just 5 minutes. This event, famously referred to as the flash crash, marked a moment of extreme anxiety and surrender in the financial landscape. It took authorities 5 years to identify the alleged mastermind behind this crash, a solitary British trader by the name of Navinder Sarao, who gained name as the Hound of Hounslow. U.S. regulatory agencies accused him of manipulating the market, alleging that he reaped approximately $40 million from his activities. Now, while the average person might be searching how long does it take to make $1 million in the stock market in hopes of achieving a financial milestone, this man managed to amass an amount beyond one's comprehension only from the comfort of his bedroom. Well, seriously, if you're aiming to accumulate $1 million, you'll need to exercise patience and allow your money to grow over time. The precise duration to reach your goal is contingent upon the returns you earn on your investments. For example, if you manage to secure an average annual rate of return of 10%, which aligns with the stock market's historical performance, it will take approximately 25 years to go from 100,000 to 1 million. Perhaps market manipulation seemed like the sole option available. Even with all the accusations, Sarao didn't seem like the typical mastermind you'd expect. He lived in a regular, working-class neighborhood not far from London's financial district. It was hard to believe that someone who was involved in such massive trading operations was just a single trader working from his suburban home. It struck many as absurd to believe that a trader operating from a suburban residence in England could have the power to disrupt the entire market. This led to inquiries about why, if he truly had made $40 million as claimed by U.S. prosecutors, he continued to reside on the same street. Sarao was an all-rounded complex figure, viewed both as a deceptive market manipulator and a brilliant individual from a less privileged background who dared to confront the established financial order. Prior to Nav's entry into the financial world, his family had escaped poverty in India, hoping for a better life in London, UK. Nevertheless, immigrating to a Western nation did not guarantee instant opportunities. Their journey began with challenges, but Nav was destined for a more promising future. Navinder Sarao was a regular guy, hailing from a working-class neighborhood situated under the Heathrow flight path. He was known for his sharp wit and occasional bouts of quick temper. Sarao had a knack for mathematics and speedy thinking, which motivated him to pursue a career in trading. But many people think Nav's foray into the trading world was merely accidental. While pursuing studies in computer science and mathematics in college, he became aware of a roommate who had discovered a method to earn extra money by trading technology stocks with a student loan. Intrigued by the potential for financial gain, Nav set out on a path of self-learning, eagerly absorbing knowledge about the intricacies of trading. Following his time at university, he responded to a job advertisement in the Evening Standard that was looking for futures traders capable of handling high-pressure situations. This opportunity led him to trading arcades, where traders were expected to make profits through their decision-making skills, and learning took place right on the trading floor. Sarao secured a position at Futex, an unassuming trading firm located above a supermarket, a world apart from the bustling city skyscrapers that typically define the finance industry. With a background in computer games, he easily brought a unique set of skills to the trading floor. His exceptional ability to maintain focus and dive into tasks for extended periods made him one of a kind. As time passed, he deliberately distanced himself from his colleagues, fashioning a solitary workplace bracing with ear defenders to shield himself from distractions. This self-imposed isolation served to amplify his concentration and trading skill, earning him a reputation as an enigmatic and almost godlike figure among his peers. His unconventional approach and uncanny ability to navigate the markets further added to the mystique surrounding Sarao. Navinder Sarao became an enigmatic figure among fellow traders because of the enormous profits he was raking in and the scale of his trading activities. His primary focus was on trading the E-mini, which closely followed the S&P 500, serving as a key indicator of the U.S. stock market's performance. Utilizing his sharp market analysis and seemingly supernatural knack for forecasting market fluctuations, he assessed the market's likely direction, gauging whether it would rise or fall by scrutinizing the flow of orders entering and exiting the market. Sarao departed from Futex in 2008, a period marked by the global financial crisis, Great Recession, during which very famous and prominent financial institutions, including Lehman Brothers, were facing collapse. At that juncture, he had already amassed approximately $2 million, and he recognized an opportunity amidst the market chaos. He executed a career-altering trade, placing a bet on government intervention to rescue the struggling banks, a move that ultimately proved impeccably timed. With government interventions causing prices to rise, Sarao's wealth swelled from $2 million to $15 million. Even with this newfound success, he made a deliberate choice not to splurge the money or disclose his wealth to friends and family to avoid appearing like a show-off. Sarao's frustration naturally came from the emergence of high-frequency traders, HFT, in the market. High-frequency trading involved the use of computer algorithms designed to replicate human decision-making, enabling them to trade at extraordinarily rapid speeds and capitalize on minor price disparities. Sarao's main concern wasn't so much about market fairness, but rather the impediment these HFT robots posed to his ability to make money. In 2009 and 2010, Sarao made a big and most important choice of his life to create his own trading robot right from his bedroom, as a countermeasure against the HFT firms. His objective was to influence the market, and after overcoming some initial obstacles, his robot started performing remarkably well. He gained the ability to consistently impact the world's second-largest futures market, leading to great profits. In the week leading up to the flash crash, he raked in $400,000 one day and an amazing $800,000 the next, all while living in Hounslow, where his parents' house was valued at $300,000. The flash crash that occurred on May 6, 2010 was characterized by intense and unpredictable market swings. It left a sense that central banks and financial institutions had lost their grip on the situation, which only added to the turmoil in the financial markets. There's a unique index in the financial world known as the Fear Index, and it essentially keeps tabs on market volatility. On that particular morning, it had surged by a mighty 30%. This is where Navinder comes into the picture. He decided to utilize his computer algorithms to introduce a barrage of sell orders into an already tumultuous and highly volatile market. For Nav, it was akin to a big wave surfer assessing the ocean swells, and he found himself facing massive waves. It was like a dream come true, a rare opportunity that only comes around once in a blue moon. At precisely 9:30 in the morning, he switched on his computer and initiated this flood of sell orders, all driven by his algorithm. As the afternoon came, he reached a point where he was placing orders worth a huge $200 million, and he was experiencing big successes as the market responded to his moves. It was becoming a main winning moment in his trading journey. But at precisely 1:40 p.m., for reasons that aren't entirely clear, perhaps a call from his mother for dinner as it was 7 o'clock in London, Nav made the decision to shut down his computer. He must have felt it was a fantastic day's work, having earned a huge $950,000. With his actions done for the day, he was unaware of what was about to unfold. Just 1 minute after Nav's computer went offline, the market commenced a downward spiral at an unprecedented rate and intensity. Traders on the floor couldn't believe their eyes. They were witnessing what they would later describe as the most bewildering day in their careers. Nav, at this point, was merely a spectator as the market plummeted dramatically. giving rise to the infamous event known as the flash crash. This crash managed to wipe out many $1 trillion from the value of American companies in a mere 5 minutes. It was a moment of financial history marked by extreme turmoil and astonishment. This unprecedented drop, the largest sudden fall ever recorded, was followed by a swift rebound in the markets. In response to this surprising event, officials were scheduled to convene meetings with executives from the New York Stock Exchange and NASDAQ during the week. They aimed to investigate whether the variance in rules among different exchanges contributed to the rapid and chaotic descent in the market on that fateful Thursday. In the coming months, an extensive and thorough examination would be carried out to reveal the intricate details of what transpired on that particular day. This inquiry would surround identifying the traders involved and delving deep into the heart of this perplexing mystery, which was very much hidden in uncertainty at that point in time. The goal was to get to the bottom of what had occurred during a period marked by out-of-ordinary market turbulence. A few months later, U.S. regulators released an extensive report delving into the events of that day. Surprisingly, this 100-page report made no mention of manipulation and certainly didn't allude to a trader operating from his bedroom in Hounslow. As for Navinder, he remained completely oblivious to these U.S. investigations, and his trading success continued to grow. However, as time passed, the exchanges and regulators began to take note of Navinder's high cancellation rates for orders. There came a point where he received a letter from the exchange, essentially requesting an explanation for his trading activities. In a rather defiant and memorable response, he tells them to kiss my ass. In the end, it wouldn't be the regulators who would apprehend Nav. Instead, it would be someone much like him, another day trader. This individual wasn't trading from his bedroom, but was working at a small firm in Chicago. He was in the process of backtesting his own software and, quite coincidentally, observed a peculiar pattern. On the day of the flash crash, he noticed a series of unusual order blocks entering and exiting the market, catching his attention, and he blows the whistle. This whistleblower stepped forward and reported the unusual trading activity, which eventually made its way to the Commodity Futures Trading Commission. It's worth saying that the CFTC had primarily functioned as a regulator for agricultural markets for many years. Analyzing the intricate details of financial markets at a granular level was a highly complex task. At that time, only a handful of individuals at the CFTC possessed the expertise required for such an investigation. One of them was Jessica Harris, who was among the select few with the knowledge and skills necessary to get into this intricate financial puzzle. The data analysis of Nav's trading activities revealed a pattern where he would group orders together and modify them multiple times, sometimes even in the hundreds or thousands, before eventually canceling them without executing any trades. U.S. prosecutors alleged that Navinder Sarao was involved in illegal trading practices, specifically a strategy known as spoofing and layering. In these practices, traders intentionally inundate the market with orders for a particular security, with the intention of subsequently canceling those orders. This tactic artificially influences the price of the security, either driving it up or down, and is considered unlawful in financial markets. After about a year, the CFTC begins to feel confident that they've pinpointed examples of genuine manipulation, particularly manipulation on a massive scale. To take things to the next level, they made the decision to involve the Department of Justice. This is a big move now, because the Department of Justice possesses the authority to press criminal charges, issue subpoenas, and potentially lead to individuals facing imprisonment for their actions. In February of 2015, a judge signs an arrest warrant for Nav. At that point, Nav's fate is essentially sealed, although he remains unaware of it. On the morning of the arrest, a team assembles, including a half a dozen police officers, 2 U.S. Justice Department prosecutors, and 2 FBI agents. They meet at a McDonald's restaurant that Nav is very familiar with, located about a mile from his home. They gather there to plan the arrest of the man they perceive as a criminal mastermind. As the sun begins to rise, they quietly navigate through the streets of Hounslow and reach Navinder's residence. Upstairs in his bed, Navinder remains asleep, oblivious to the impending arrest. The moment they knock on the door, Nav's father answers and calls for him upstairs and down the stairs. Nav descends, wearing tracksuit bottoms and a t-shirt, his hair disheveled, and he appears completely confused. As he's led out of the house in handcuffs, he turns to one of the officers and asks, "Can I run upstairs for a minute, bruv? There's a football match on telly that I want to record." The officer responds, "I don't think you're going to get a chance to watch that for a while, son." Indeed, as it turned out, he wouldn't set foot in the house for another 4 months. This turn of events was quite challenging for the people in this neighborhood to comprehend. It's a genuine working-class community, and Nav's arrest was a great and unexpected development. Many people in the financial markets, especially those like Nav who operated on the fringes as day traders, held him in high regard. He was seen as a role model who had built a big wealth from humble beginnings and had devised a means to challenge a system where the most financially backed and well-connected firms typically reign supreme. For people in similar circumstances, it often felt nearly impossible to achieve profitability within this competitive landscape. So, Nav became somewhat of an idol. The British trader accused of playing a role in the May 2010 flash crash found himself behind bars overnight. The legal system brought a heavy barrage of charges against him, totaling 22 criminal counts that could potentially result in a cumulative sentence of 380 years in prison. In response, the judge assessed his considerable earnings and set bail at £5 million. For Nav, whose wealth amounted to tens of millions of pounds, meeting this bail requirement should be a relatively straightforward matter. It's not entirely clear how much money he made, but considering his reputation as a skilled trader, it's reasonable to assume that he might have a significant sum at his disposal. However, the mystery arises from the fact that, despite being granted conditional bail, he's been unable to post the required $7.5 million. As a result, he remains in custody. As Nav's legal team reaches out to his various investment advisors who have managed his funds over the years, they encounter a troubling development. These advisors begin to avoid their calls. Over time, it becomes increasingly evident that the money Nav had set aside and the profits he had accumulated throughout his successful trading career may not be as secure as he had believed. The realization dawns that this financial situation is far more precarious than he initially thought. It does appear that Nav may have fallen victim to a scam that has potentially cost him $50 million. It's a story that seems almost too astonishing to be true. It appears that Nav entrusted his money with various entities that promised attractive returns, some even claiming to offer risk-free investments. He seemed quite willing to place his funds with these entities, and this has led to the troubling situation he finds himself in. As we talked about it earlier, Nav is a complex figure, a brilliant trader on one hand and a somewhat naive individual with no prior experience working at a bank or in a commercial environment. Unfortunately, he appears to have been deceived by certain individuals. The majority of his funds were entrusted to an entrepreneur named Jesus, who ultimately admitted to losing it all and pledged to repay Nav when possible. In a turn of events, the judge decided to reduce his bail, and his parents had to put their house up as collateral to secure his release. The British trader accused of being involved in the May 2010 flash crash was set free on a $7.5 million bail. The judge determined that he should be extradited to the United States to face trial. Following his release, Nav's attorney, who had formerly worked at the Department of Justice as a prosecutor, traveled to Washington and attempted to negotiate a deal. He proposed that while they could proceed to trial, there was a risk of losing, given Navinder's vulnerability. There was a concern that a jury might sympathize with him, so the suggestion was to strike a deal. In the end, Nav's transformation from someone who initially appeared to be part of a bank or a high-frequency trading operation based on his trading activity and earnings to an individual trading alone from his home was a big evolution in his story. He maintained a frugal lifestyle, which added to the intrigue of his case. Nav's motive for his actions was challenging to discern. The Department of Justice weighed the situation and ultimately reached an agreement with him, leading to his guilty plea. When it came time for Nav's sentencing, the U.S. authorities had a significantly altered perception of him. On one hand, he had been extraordinarily cooperative, shedding light on the practices of market abuse and assisting in building several cases. He proved to be an invaluable witness. However, Nav was far from the stereotypical image of a greedy financial criminal. He had been diagnosed with Asperger's syndrome by this point, which provided a context for many of his actions and interactions with the authorities. The U.S. authorities, by this stage, had a very different view of him. They penned a note to the judge, essentially stating that he had endured enough punishment, had been exceptionally helpful to them, and recommended his release with credit for time served. So they took into account his autism, time in jail already served, and that he's been helpful to the government for several years since then. It's quite a remarkable turn of events when the U.S. government states that Navinder Sarao has suffered enough and recommends his release. Considering the full scope of his circumstances, including the loss of his wealth, it's clear that the government made a judicious decision. In the end, the judge sentenced Nav to a year of house arrest, creating a fascinating circularity to his story, as it was from his home that he first ran into trouble. Nav's timing once again proved to be impeccable. Just a couple of months after his sentencing, the world was plunged into a global pandemic, and most of us found ourselves under various forms of lockdown. The financial aspect of Nav's journey was followed closely. His rise from a lone trader in his bedroom to the center of a major financial controversy and eventual redemption was something extraordinary. The impact of his actions on the markets and the subsequent legal proceedings made his story a gripping saga. This leads us to one last question. How common are these types of crimes? Potentially fairly common. Most countries, including the UK, do not specifically list spoofing as a crime. It's only been illegal in the United States since 2010, with the first successful case brought against U.S. trader Michael Kosicka in 2013. The practice of spoofing in financial markets, though not explicitly illegal in all jurisdictions, raises significant ethical and legal concerns. Financial markets rely on a delicate balance of trust and transparency. However, in recent years, a practice known as spoofing has come under scrutiny for its potential to undermine the integrity of these markets. Spoofing involves creating a false appearance of market activity through deceptive trading strategies, primarily in electronic trading platforms. Potentially, spoofing is a fairly common practice in financial markets, yet its prevalence varies across different jurisdictions. Most notably, the United States took a significant step towards addressing spoofing in 2010, when it was officially deemed illegal under the Dodd-Frank Wall Street Reform and Consumer Protection Act. This legislation gave the Commodity Futures Trading Commission the authority to prosecute those engaged in spoofing, marking a critical milestone in the fight against market manipulation. Many countries, including the United Kingdom, do not explicitly list spoofing as a criminal offense, and this divergence in regulatory approaches has implications for the occurrence of spoofing worldwide. However, the case also raises crucial questions about the thin line between legal and illegal market manipulation. After all, traders are tasked with capitalizing on market inefficiencies, and this is how they make their living. Legitimate trading strategies may involve taking advantage of price discrepancies and arbitrage opportunities, making it challenging to differentiate between legitimate market activities and deceptive spoofing. Furthermore, algorithmic trading is an integral part of modern financial markets, and it's not inherently illegal. Algorithmic trading involves the use of computer programs to execute a high volume of trades at speeds that surpass human capabilities. It's become increasingly prevalent due to its efficiency and the ability to execute complex strategies within milliseconds. Algorithmic trading can offer liquidity to the markets and improve price discovery, but it can also be used for spoofing and other manipulative practices, blurring the ethical boundaries of trading. Spoofing raises ethical questions that go beyond legal definitions. Market participants are expected to operate with integrity and transparency to maintain trust in financial systems. The deceptive nature of spoofing undermines this trust by creating false market signals, potentially leading to price distortions, economic losses, and an erosion of market confidence. The ethical dilemma lies in the exploitation of market mechanisms, where traders capitalize on their own false orders to profit at the expense of other market participants. This practice undermines the principle of fair and open competition in financial markets, which is essential for their proper functioning. To address the ethical and legal complexities of spoofing, regulatory authorities have taken steps to define and prosecute such practices. The U.S. regulatory framework, as established by the CFTC, provides a clear example of efforts to combat spoofing. Similarly, financial institutions, under regulatory scrutiny, have been fined for their involvement in spoofing activities. For example, UBS, Deutsche Bank, and HSBC paid a collective $46.6 million to U.S. regulators to settle spoofing claims. These fines serve as a deterrent and reinforce the message that spoofing is unacceptable behavior in the financial industry. Detecting and prosecuting spoofing can be challenging due to the rapid pace of modern markets and the complexity of electronic trading. Traders using sophisticated algorithms can hide their true intentions and intentions behind legitimate trading activities. Regulatory agencies often rely on advanced surveillance technologies to monitor and identify potential spoofing. However, the effectiveness of these surveillance systems can be limited, and there's a consistent cat-and-mouse game between regulators and market manipulators. To mitigate spoofing, market participants, including traders and institutions, are trying to be educated on the risks and consequences of engaging in manipulative practices. Over the course of his trading career, Navinder Sarao managed to accumulate around $70 million. It might be tempting to imagine a hidden twist where Nav squirreled away a few million for a future escape to a desert island, but upon close examination, this doesn't seem to be the case. The truth is that Nav is essentially penniless. Strangely enough, it hasn't made a great difference in his life. He still goes about his daily routine, cycling around Hounslow on his bicycle, playing football with his friends, and enjoying a fillet of fish from McDonald's. It's a proof to the fact that for Nav, money never held much meaning, and its absence hasn't drastically altered the way he lives. Through the various ups and downs of his life, Navinder Sarao's story shows the complexity of the financial world and the fine line between brilliance and controversy. It's a narrative that keeps you wondering about the ever-evolving landscape of modern finance and the intriguing characters who rule it. On February 4th, 2013, 6 minutes after the stock market opened in Tokyo, many well-known stocks, including SoftBank, hadn't been traded yet. SoftBank's offer price dropped by 5% and kept falling, but nobody was willing to buy it. After some time, a purchase order was completed. 300,000 shares were bought at 6,714 yen per share, totaling just over 2 billion yen, which is almost $21 million. This triggered more buyers to join in, creating momentum, and by the end of the day, the stock became one of the only 2 gainers in the Nikkei 225 stock average. The person who made the market activity for SoftBank on that winter morning was sitting in pajamas in a bedroom filled with comic books. He leaned into the bright light of 4 computer screens while munching on a carrot, perhaps to soothe his stomach. Investing in stock rebounds was risky, but observing SoftBank's 20% value decline over 9 days, coupled with a further drop in U.S. markets overnight, convinced him that the chances of a bounce were increasing. Assessing the situation, he made the decision to act, rapidly placing orders to execute his strategy. An hour and a half later, he sold his holdings, making a profit of 140.6 million yen, $1.46 million. I do my best work when other people are panicking, he said, about an hour after winding up the biggest trade of a long career betting on stocks. Without pausing, the former video game champion and pachinko gambler known as Sis swiftly moved on to the next trade. The 35-year-old day trader claimed to have earned 6 billion yen, almost $63 million after taxes, by betting on Japanese stocks that day. Over the course of a decade dedicated to day trading, starting practically from the ground up, Sis claims to have accumulated a fortune surpassing 16 billion yen, $167 million. Along the way, he has gained a cult following among Japanese day traders, a close-knit community of self-taught experts who pride themselves on navigating one of the world's toughest markets. Sis in that era became a subject of considerable discussion and speculation, even prompting the creation of a Wikipedia page to document his investment outcomes. He presented several statements from one of his numerous brokerage accounts for the year 2014, along with his tax return for 2013. These brokerage statements indicated liquid assets ranging from 4.4 billion yen to 4.8 billion yen. His tax return revealed that he traded Japanese equities worth 1.7 trillion yen in 2013, approximately 0.5% of the total value of individual share transactions on the Tokyo Stock Exchange. On his most active day, he claims to have bought and sold stocks totaling 70 billion yen, over $700 million. That's the end of my epic rebound trade. His profit, he said, had almost tripled. Sis discovered he had a talent for winning games. At 15, he says, he could earn 400,000 yen a month gambling. One secret was identifying the machines most likely to give bigger payouts. Another was being able to endure 13 hours at a time in smoke-filled and deafeningly loud pachinko parlors. He had to play thousands of consecutive games to take advantage of the odds. You need to find an edge and exploit that edge and do it over and over again. If you're a day trader or a swing trader, then you know that you have to do a lot of trades to make a difference in your account for the year. CIS, pronounced Sis, means death in classical Japanese. The nickname is a holdover from his gaming days when he used to crush foes in virtual wrestling rings and online fantasy worlds. Games taught me to think fast and stay calm, he said over tea at Tokyo's Hotel Grand Palace a few days after the SoftBank trade. Rail thin, with a shaggy mop of hair, he showed up in a gray sweater, jeans, and sneakers. No one would have taken him for a multi-millionaire. Sis wants people to know what he's accomplished. He just doesn't want them to know who he is. Even after 6 sit-down interviews over many months, Sis asked not to be named for this story. Married with 3 kids, he says he's worried about being targeted for robbery or extortion. He said being a Japanese day trader in 2013 proved to be highly lucrative. Thanks to Prime Minister Shinzo Abe's efforts, the Bank of Japan injected cash into the market through an asset-buying program. Additionally, a loosening of borrowing limits enabled traders using margin to quickly roll over loans upon exiting a position. Now, the combination of these 2 factors created a powerful and favorable environment for day trading. In 2013, the benchmark Nikkei 225 experienced a big surge, increasing by over half, marking the most substantial gain in 4 decades. The Mothers Index, consisting of small-cap stocks and popular among retail investors, saw an astonishing rise of 137%. The Tokyo Stock Exchange reported that the volume of shares traded by individual investors more than doubled during this period. It wasn't because more people were pumping retirement money into the market, though Abe's policies were meant to encourage that. It was super active day traders, says Akira Warita, managing director at Matsui Securities. 1% of the online brokerage's clients accounted for 70% of its turnover during the last 3 months of 2013. The 397 people who made 50 or more trades a day were responsible for more than half of the brokerage's margin transactions. The most leveraged trader used a cash deposit of 20 million yen to buy and sell 4 billion yen worth of equities in a single day. The truth is, Japanese day traders have gotten so big, the market can no longer ignore them or the huge price swings they amplify, says David Baran, co-chief executive officer of Symphony Financial Partners, a $455 million Tokyo hedge fund firm. I've been trading Japanese stocks for almost 30 years, and I've been through periods of extreme volatility, but I've never seen anything like what we've seen in 2013, Baran says. Sis's first big score came on December 8, 2005. Back in 2005, someone at Mizuho Securities made a big mistake. They wanted to sell 1 share of a small company called JCOM for 610,000 yen, but they accidentally offered 610,000 shares for just 1 yen each. This was way more than the actual number of shares available. Sis, along with a few other traders, saw this had to be a mistake and quickly jumped in. Sis says he bought 3,300 shares, about a quarter of the total, at the very low price. That's how he made his first big win. When the confusion was cleared up, Mizuho Securities had lost its quarterly profit, and according to Sis, he was 600 million yen richer. Another day trader named Takashi Kotegawa, known as BNF, reportedly made over 2 billion yen. Even today, the JCOM trade stands out as the best 10 minutes of Sis's professional life. However, he didn't take the time to celebrate. Instead, he swiftly moved his winnings into the video game company Nintendo. His logic was that the likely legal issues arising from the morning's events, it would be more challenging for anyone to take away his gains if they were invested rather than in cash. Additionally, he took a negative stance on brokerages by shorting them, anticipating that financial shares might face consequences due to the earlier mistake. Several fan blogs devoted to Sis sprang up after the JCOM trade, one called Sismania. That site is no longer around, but in the summer of 2013, someone offered a Wikipedia page about Sis. It's complete with a bar chart purporting to show how his fortune snowballed, starting with 1 million yen, about $10,440 in 2000. The numbers are a little off, Sis says, but the basic idea is right. In the early days of his career, Sis gained recognition by engaging in trash talk on 2 Channel, Japan's most popular online bulletin board. He became infamous for lines like, "Even Goldman Sachs can't outtrade me," and "I'll casually flush some cheap wine that only set me back 800,000 yen. In 2011, Sis made a rare TV appearance on the popular variety show Warate Litomo, which translates to "It's okay to laugh." The show has since ended after a 32-year run. During the appearance, he wore a translucent box over his head and used a voice modulator to speak, preserving his anonymity. "Who are you?" the host asked. "I'm a man who made 10 billion yen day trading," Sis answered. and the crowd went wild. At the time, his fortune was just over 9 billion yen, Sis says, but producers told him to round up. To help support his claim, producers held up an enlarged statement from one of Sis's bank accounts, showing a balance of 1,269,223,316 yen. While the typical banker might not have recognized the figure on TV, day traders were well aware. "The guy's a star," remarks Naoki Murakami, a trader known as Murayan in the blogging world. Everyone read his 2-channel posts. Some folks may not have appreciated them, but most understood he was joking. Known for documenting his trades openly online, not shying away from sharing both successes and failures, Murakami has gained a degree of celebrity himself. He is even compensated by brokerages like Matsui Securities to speak at investor conferences. He shares online chat room buddies with Sis, a common type of connection in Japan's day trader community, where everyone is interconnected through several layers of chat room relationships. Some traders are so close that they even go on vacations together. For instance, Murakami and 3 other traders went to witness Canada's Northern Lights a year ago, and the previous spring they chose Bali as their destination. In person, it's not easy to square Sis with the bravado of his online alter ego or his wealth. Pale from hours staring into computer monitors, he looks like the video game junkie he once was. Stress has given him chronic stomach pain and a dusting of gray at the temples. Sis's social circles consisted mainly of fellow traders, including individuals like Kenji Uemura, a former Sony engineer who authored a popular trading guide now in its 5th edition. Uemura, 39, sporting an Elvis-style hairdo and sideburns, claims to have accumulated 300 million yen over a decade of trading. Similar to Sis, he's not one for flashy displays of wealth. "The type of person who squanders money on those things would never have reached this level," remarks Uemura, known among traders as Kimu. "Self-control is so important. You have to conserve your assets. That's what insulates you from the downturns and gives you the ammunition to make money." Skipping class in high school to play pachinko, a hybrid of slots and pinball, as we know, Sis discovered he had a talent for winning games at a very young age. Sis shares that he barely managed to obtain his degree in mechanical engineering because he spent much of his college time immersed in the fantasy role-playing game Ultima Online. Confined to his bedroom, he dedicated days on end to exploring the game's virtual world, accumulating weapons, treasure, and food. He describes this period as an early lesson in the acquisition and safeguarding of assets. Wicked keyboard skills were a must. He mastered them all. He memorized over 100 keyboard shortcuts like Control-A to gulp a healing potion or Shift-S to draw a sword, and effortlessly navigated between them without glancing away from the screen. "Some people can do it, some can't," he remarks with a shrug. However, the game imparted a more significant lesson, knowing when to make a strategic retreat. "I was a pretty confident player, but just like in the real world, the more opponents you have, the worse your chances are," he says. "You lose nothing by running." That's how he now plays the stock market. CIS says he bets wrong 4 out of 10 times. The trick is to sell the losers fast while letting the winners ride. For him, a well-played stop-loss is just about the most beautiful trade there is. That's why he believes a less attention-grabbing SoftBank trade than the one in February might turn out to be his most strategic move that year. On the first trading day of the year, he sold 4.5 billion yen worth of SoftBank shares. Although he incurred a 2.5% loss on that day, he exited the position with a 650 million yen profit. He had been building this position since mid-October. After his sale, SoftBank experienced an 18% decline in the following month. Later, regulatory filings revealed the reason. Capital Group, a massive U.S. fund trader, had been unloading the shares. Stocks entered the picture for Sis when he was in his early 20s and working as a designer of industrial shock absorbers at a small manufacturer. He began by betting on what he thought were undervalued companies, and he lost money. He found success after a friend gave him a piece of advice: forget the fundamentals. Sis doesn't subscribe to the Nikkei or any other newspaper, nor does he scrutinize earnings reports or parse central bank statements or spend much time looking at moving averages or other price chart patterns normally associated with technical trading. Instead, he keeps his ears open in the chat rooms and his eyes glued to bid-ask screens, on which he monitors the market's appetite for its 300 most heavily traded stocks. If there's one basic principle, he says, repeatedly and slowly, as if instructing a child, it is this: buy stocks that are being bought and sell stocks that are being sold. This has deeper implications than it may seem, said Hirsch Jeffrin, a professor of behavioral finance at Santa Clara University in California and the author of Beyond Greed and Fear, a 2007 book that explores the role of psychology in investing. Jeffrin argues that the human mind is inherently inclined to bet on reversals, highlighting the psychological aspects that influence investment decisions. It's a phenomenon called the gambler's fallacy. At a craps table, for example, players tend to shift their bets toward numbers that haven't come up, even though the odds don't change with each roll of the dice. In the same way, even the savviest investor has a built-in bias for buying when stocks fall and selling when they go up. Like all day traders, he liked to capitalize on momentum. If you can get yourself out of that mindset and bet against the crowd who act instinctively, then you have an opportunity to make money. After 2 years of mastering the art of riding momentum, Sis claims to have made 80 million yen by day trading discreetly while holding a regular job. In late 2003, he decided to leave the traditional office life behind and transition to working in the market full-time. Since then, there have been more than 1 million trades, Sis estimates. Early on, he held most positions for just seconds at a time, making hundreds of moves each day. Now that he has more money, there's no choice but to hold positions longer, because shifting such large sums in and out of the market influences prices. In early July 2014, as a slow trading day was winding down, Sis sent an email containing a screenshot of his brokerage account at SBI Holdings. The snapshot resembled others he had shared in person throughout the year. On that day, unrealized gains were in the red, 200 million yen. His portfolio included 254,000 shares of Toyota, 4.2 million shares of Nomura Holdings, and 6 million shares of Mitsubishi UFJ Financial Group, among a dozen other positions. The total portfolio amounted to 13.2 billion yen, financed with 4.4 billion yen in cash. He anticipated that entire portfolio would likely be sold off within the next few days. One thing Sis wouldn't sell was a 100-share stake in Yoshinoya Holdings, operator of a fast food chain beloved by cash-strapped college kids. It's a little keepsake, he explained as he quickly walked to a mahjong parlor in the Roppongi nightlife district, where he has a regular 3 p.m. game with trader buddies. When Sis wasn't betting on stocks, he was gaming elsewhere. He played low-stakes mahjong most afternoons after the market closed and is ranked in the top 99.94 percentile of 3 million players on a site called Tenhu, where he played under the name Sis. When he's not playing mahjong, Sis is often engaged in poker or blackjack, both online and occasionally in person. He mentions being barred from South Korea's Walker Hills Casino in 2011 for card counting during his visits. Most of Sis's wealth is in stocks and cash. He also holds corporate bonds and gold, he says, and has stakes in 3 small businesses. Tax records show he owns 2 apartment buildings, the larger of which, a modernist cube in central Tokyo with a French bar on the ground floor, could easily be worth the 700 million yen Sis says he paid for it, according to an estimate from Tokyo real estate consultant Mount Partners. Many of the day traders in Sis's circle can be considered wealthy, especially after the bull market of 2013. But Sis is on a different level. How he managed to build a fortune of such size is a subject of much speculation among his peers and the world. It could be an ability to spot weaknesses in trading algorithms used by the big banks, Murakami says. Or maybe it's the simple fact that he doesn't get rattled, says Masahiro Kawata, a trader who plays mahjong with Sis. Kawata designed the trading interface that most serious Japanese day traders use to shave valuable seconds off the order process. It's called T++ Speedy Stock Order Tool. Kawata says his friend can think like a machine. Then there's his single-mindedness. Sis doesn't seem to regard trading or amassing money as a means to anything. Trading is the point. Winning is the point. It's not a sentiment Sis shares. According to him, if you just consider compound interest, it should be pretty easy. Only a handful of his peers know his real name, and no one has watched him work. Sis didn't offer a complete accounting of his investing returns and his wealth for this story, and some of his claims can't be verified. For all you aspiring money managers whose interest is not just gathering assets, but to outperform the market, then realize that the more money you trade, the harder it will be. Having too much money to trade is one of the biggest hindrances to a money manager's performance. This is a great inspiring story, it really is, especially when all you hear nowadays is all the reasons why it can't be done. It can be done, but not by 99% of the people out there. Your biggest obstacle in trading is you, and many can't get over that hump. In 2005, billionaire investor Masayoshi Son sought new ways to grow his wealth, despite already possessing $4.3 billion. But not everyone crumbles under such pressure. During this time, a figure known as BNF gained recognition through a remarkable J-Com trade. He became a Japanese legend, celebrated as the J-Com man. Yet, to BNF, it was merely one trade. His life consisted of simple pleasures, cup ramen, anime, and the solitude of day trading from his room. Even after earning a great 2 billion yen from a single trade, BNF's drive remained unaltered, always seeking the next challenge. As he navigated newfound fame, an impending global bear market threatened the big financial bubble of his lifetime. Recognizing the need to cut through the noise, BNF adhered to his unorthodox anti-establishment approach. He refrained from seeking favor from those with deep pockets and established connections, instead choosing an unpretentious, unprofessional trading setup within his modest apartment. This approach symbolized BNF's deep trust of the prevailing financial system. This is the incredible true story of how a broke Japanese college student turned a small sum of $13,600 into an astonishing fortune of over $153 million in just 8 years. Let's go back to where it all started. Back in 1986, in the bustling city of Osaka, a young BNF was leading a life that felt somewhat monotonous. Spending most of his days indoors, it seemed like a routine existence. But then, an unexpected blessing came his way, and suddenly his world became a lot brighter, adding in him the belief that one could outsmart the system. BNF was experiencing the typical college life, filled with experimentation and soul-searching. His daily routine consisted of indulging in ramen, anime, and sake. Little had changed until that one fateful day in 1998. It was then that NHK, a famous Japanese TV network, aired a 4-part series searching into the world of finance. The first episode, intriguingly titled The Man Who Lost 50 Million, chronicled the life of the legendary hedge fund manager Victor Niederhofer, a man known for his speculative prowess and his fund's roller coaster journey through the world of options on index futures. This TV series, in particular, left a profound impact on BNF. It stirred something within him, igniting his passion for the world of finance, trading, and the lifestyle it offered. In fact, he was so inspired by the documentary, Victor Niederhofer's life, and his trading acumen that he even based his trader name, BNF, on Niederhofer. The allure of trading and the freedom it promised resonated deeply with BNF. This was the life he had always dreamed of, but there was a stark contrast. BNF wasn't born into privilege. At that time, he was just a broke college student. The prospect of amassing savings to begin trading seemed like a distant dream. Learning about trading was equally daunting, especially without the vast resources available today, like YouTube. In the 1990s, Japan had limited resources and textbooks on trading, particularly trading via a computer. There was a scarcity of information, but none of this deterred BNF. The excitement of potentially making millions through trading consumed him, and he was captivated by the intricate world of stock charts. Despite the odds stacked against him, he was resolute about becoming a day trader. During his college days, BNF undertook part-time jobs, working tirelessly on weekday nights and weekends. Aside from covering his rent and cup noodles, he saved every penny he could. In the gaps between college lectures and work shifts, he devoted every available moment to studying charts. Day in and day out, he analyzed price movements, observing the ebb and flow of stocks, particularly those within the Japanese Nikkei index. Over time, he started to discern patterns and meaning within the intricate dance of stock prices. In the absence of readily available information, he embarked on developing his own theories about how the market operated. BNF committed himself wholly to this endeavor, sacrificing his time and social life. After 2 years of relentless effort, working part-time jobs and immersing himself in chart analysis daily, BNF had scraped together $16,000. The moment had arrived. He was ready to confront the markets, armed with youthful enthusiasm, determination, and discipline. However, the market he encountered was far from forgiving. As history tells us, in the year 2000, the global stock market was reeling from the bursting of the internet bubble, also known as the dot-com bubble. Yet, what many might not be aware of is that Japan had already endured a significant asset bubble burst in the 1990s. This period, often referred to by Japanese economists as the lost decade, witnessed asset prices plummeting by over 70%, leading to a decade of profound economic distress. BNF, after 2 years of chart analysis, faced initial losses in the trading world. However, these setbacks led him to develop a straightforward yet brilliant strategy. In a bear market where fear dominates, people tend to oversell declining stocks, fearing further losses and underestimating short-term recoveries. BNF's strategy was known as contrarian trading. He observed that during bear markets, traders often panic and sell off stocks that deviated at least 20% from the 25-day moving average, with 35% considered a safer buying point. Prices would then rebound, allowing BNF to close trades with profits. But this strategy wasn't a guaranteed success. BNF encountered more losses than wins, causing his savings to dwindle. He realized that some market sectors posed greater challenges. Despite the setbacks, he understood that achieving overnight success was unlikely. So he concentrated on understanding his losing trades. Through a careful study of losing charts, BNF identified repeating patterns in specific sectors with varying deviation percentages. He noted that different sectors had their own deviation ranges from the moving average. For example, 22 to 30% for service sector stocks, 25 to 45% for post-dot-com crash IT stocks, and 28 to 60% for emerging stocks. By applying sector-specific percentages, BNF improved his timing and entry points during temporary market upswings. This required him to develop a keen sector awareness before market trades. With dedication, BNF began to achieve more wins than losses. However, by December 2001, the bear market grew even more turbulent, with a significant crash in penny stocks resembling a market-wide sale. BNF's friends from the two-channel community saw this as a golden buying opportunity, but BNF's instincts told him otherwise. Instead of buying everything in the midst of a fire sale, he focused on stocks that had dropped significantly more than the market average, with deviations close to 65% off the 25-day moving average. His decision paid off as the selected stocks rebounded within a short span, with some even doubling in just a few trading days. BNF's disciplined approach and his deep understanding of market dynamics yielded fruitful results. Had BNF followed the conventional path and bought stocks at typical levels like his friends, he would have suffered catastrophic losses. Instead, by the end of 2002, BNF had impressively grown his account to $1 million in US dollars. He had transformed into the prominent bear among Japanese day traders, and the thrill of his success was exhilarating. He was finally able to sustain his life through his trading. However, a great tragedy loomed on the horizon that would drastically alter BNF's worldview. It was a peculiar tragedy, considering the entire world was experiencing a massive bull run. While everyone else was ecstatic, BNF was feeling an overwhelming sense of stress. The tragedy, as it turned out, was the transition from a bear market to a bullish one. You see, BNF's trading strategy thrived in a bear market where fear prevailed, and his approach was tailored to such sentiment. But now, the market dynamics had flipped, and he found himself facing an entirely different approach. To continue making a living through trading, he had to figure out how to navigate and succeed in this new bull market. Adding to the stress of the situation, BNF now had a big amount of money in his pocket, and he was determined not to jeopardize the freedom he had earned. To minimize the risk of losing his hard-earned wealth, he knew he had to devise a system that could thrive in the current market sentiment. Drawing from his past experiences, BNF recognized the important role of market sentiment. To mitigate risk, he made a strategic decision. Rather than opposing the bullish sentiment, he aimed to create a trading strategy that would benefit from it. After all, in a bull market, holding on to stocks over the long term typically yields profits, but that approach didn't align with his day trading strategy. Instead of adopting a long-term hold strategy, BNF utilized his deep understanding of codependency within the Japanese market to clearly position himself to ride the wave of the bull market. When the market is bullish, core companies tend to rise along with the overall index. However, BNF recognized an intriguing pattern. Even in strong markets, not all core companies surge simultaneously. There were always some laggards, and that's where he saw opportunities. He would strategically invest in these lagging companies, riding their upward momentum for a few days or weeks before selling. Since these opportunities didn't present themselves every day, BNF transitioned to a strategy that involved just a few trades each month. Instead of forcing trades, he patiently adhered to this approach. Through years of experience, BNF had developed a unique perspective on trading, viewing it not as individual price actions, but rather as a part of a global, interconnected system. His unemotional discipline was the cornerstone of his success. This strategy proved exceptionally fruitful during the bullish market, and BNF's account grew by $10 million over 2 years. However, the story took a peculiar twist. It was December 2005, 9 a.m., on another typical morning at the Japanese stock exchange. The trading floor buzzed with excitement as several new tech companies had recently gone public, sparking traders' hopes of finding the next unicorn. But this morning, all eyes were fixated on a new stock, JCOM Holdings, making its debut on the emerging markets. Within minutes, panic engulfed the trading floor as JCOM appeared to be experiencing one of the most significant stock drops in history. Traders were baffled and hesitant to buy, fearing potential financial fraud. The internet erupted with discussions on this unprecedented event. Meanwhile, at Mizuho Securities, one man was grappling with a nightmare of his own. He had committed an unimaginable error. His job was to sell a single share of JCOM at 610,000 yen, but instead, he accidentally sold 610,000 shares for a mere 1 yen each. Once the trade went live, there was no turning back. Fortunately, the Japanese exchange had measures in place, such as limit up and limit down rules, restricting how much a stock could move in a single day to prevent extreme volatility. However, these measures proved insufficient. BNF swiftly seized the opportunity. In a matter of minutes following the incident, he made his move, purchasing 7,100 shares at the limit down price, securing an astonishing 49% stake in the company. He placed half of his entire account size on this audacious trade, and his protege CIS followed suit. Panic continued to escalate, and Mizuho Securities found themselves unable to reverse their erroneous trade. In a desperate bid, they attempted to buy back as many shares as possible, but they were not the only ones in the fray. Even institutional investors had caught wind of the situation, and demand for JCOM shares surged. The stock's price began to soar as the market approached its closing hours. CIS cashed out his profits and went as far as withdrawing the money from the bank, fearing potential government repercussions. However, BNF, unlike his protege, remained remarkably calm. He opted to take a calculated risk, selling only a small number of shares. He was worried whether he would face a substantial loss, potentially jeopardizing half of his account size by holding 6,000 shares of JCOM overnight. The big question was whether BNF would face significant losses or amass a colossal fortune overnight. While most traders would have been extremely stressed, BNF remained remarkably calm. To him, this was about more than just money. It was a game, and he believed his opponent had made a major blunder. The next morning, amid all the chaos, it was revealed that trading in JCOM stock had been halted. Large institutional players, concerned about potential legal repercussions, decided to return their shares and profits to Mizuho Securities. However, rogue traders like BNF stood their ground, refusing to sell. As time passed and the government showed no signs of intervening, Mizuho Securities had only one option left: a settlement. Mizuho agreed to repurchase the shares held by rogue traders at the expected morning price of the stock. Just before the halt, this opening price had been set at an incredibly high figure of 975,000 yen. BNF reaped an astonishing profit of approximately 2 billion yen, making it one of the largest profits ever earned by a bedroom day trader. His story grabbed headlines, and he became known as the JCOM man in Japan. Niche trading communities hailed him as a trading god, and even billionaire investor Masayoshi Son took notice of his extraordinary success. Despite the high-risk nature of his trades, BNF had appeared victorious and achieved legendary status. At this juncture, he had to decide whether to go professional. He had attained a comfortable and stable lifestyle doing what he loved. In an interview, he mentioned, "I don't enjoy taking money off the market. Seeing the physical amount of cash makes me fearful of how much I'm putting on the line in trading. It makes me a worse trader." BNF soon realized that he disliked the attention and fanfare that came with his newfound wealth. While the money offered a comfortable life, he had no desire to indulge in extravagant travels or high society living. He preferred the simple pleasures of sharing a drink in town with friends. He believed that excessive spending took away from his love for trading. What truly mattered to him was the art of trading. As BNF strived to maintain his modest and contented lifestyle, the markets were changing, and a familiar storm was brewing on the horizon. Little did he know that this would be his most challenging test yet as he faced the emergence of a new bear market. It led him to return to his tried-and-true strategy, and even Japanese news outlets were covering the crumbling U.S. banking system. This was a major event, but BNF had been researching it for months. On September 13, 2008, he made a similar move to the one he made with JCOM, investing $6.5 million in Lehman Brothers stock. That year, Lehman's stock had plummeted by 73%. Japanese banks were considered safe and conservative, while Lehman Brothers was the fourth largest investment bank in the U.S., known for its strong reputation. BNF believed that a rebound was inevitable, but he made a critical mistake. He underestimated the level of corruption in the U.S. banking system and overlooked the fundamentals. He had broken his golden rule. The $6.5 million investment went to zero overnight, causing him much pain. After suffering such a painful loss, BNF vowed never to trade the U.S. markets again. However, the storm was far from over. The crash of the U.S. housing market led to a global financial system collapse. For bear market traders like BNF, times of crisis presented opportunities. On October 10, 2008, sensing an opportunity, BNF saw blood in the water. The global financial system was in turmoil, and the Japanese markets, including the Nikkei 225 index, were taking a severe hit. The Nikkei had fallen, and BNF believed in the potential for a rebound. Following his old principles, he bought in. The markets continued to move against him, and as the market closed, he faced the decision. Should he cut his losses or hold his position overnight? Relying on his past successes, BNF chose to hold. However, the Japanese markets deteriorated further. In 2008, Japan was hit hard by the global financial crash due to its heavy reliance on exports and trade openness, especially to Western markets, which were now buying fewer consumer products. Japan had also become more susceptible to stock market shocks due to its increased trade openness. The next morning, BNF woke up to a sea of red numbers. His previous deviation targets no longer seemed effective. The index kept dropping, and BNF was on a losing streak, heading towards significant losses. While many traders might have reacted emotionally and desperately tried to recover their losses, BNF remained calm and disciplined. He focused on cutting his losses short, but the hits were starting to add up. He had to go back to the drawing board and adjust his strategy. BNF understood that timing the bottom was impossible for anyone, and he believed in his strategy, which involved gradually increasing position sizes based on the 25-day moving average deviations, tailored to different sectors. After careful analysis of the market, he recalibrated his deviation targets per sector of the Nikkei index. On October 27th, the Nikkei continued to fall, and BNF attempted another rebound. The market, however, continued to move against him. As time passed, the weight of his trades grew heavier. Watching anime to calm his mind, which had worked in the past, no longer had the same effect. He wondered if he had become too comfortable. On that day, he realized his greatness didn't solely stem from his strategies, but also from his ability to filter out the noise and maintain discipline while developing his deep understanding of the market. Rather than second-guessing himself in his vast experience, BNF decided to double down on his trading strategy. As the market remained against him throughout the morning, he went on a buying spree, taking diversified positions in many of the hardest-hit companies that constituted the Nikkei. His overall position grew to $64.8 million, spread across over 90 companies. After the lunchtime close at the Tokyo Exchange, a few top names began to rally, slowly lifting the Nikkei. This positive chain reaction spilled over to more of BNF's positions before the market closed. Confident in his understanding of the markets, BNF chose to hold his position overnight. The following morning, the market continued to rally, and that's when BNF started to unload his position, yielding a profit of over $12 million. BNF had once again ascended to godlike status, revered as a trading deity among Japanese traders. In the past few years, BNF has diversified his portfolio, investing in 2 commercial real estate buildings. Commercial properties tend to have longer-term tenants and offer favorable tax incentives. Real estate is also a reliable hedge against inflation. Although he sold one of his properties, his primary focus remained trading. With no sign of changing his lifestyle and his remarkable growth, BNF was on a mission to become the world's first billionaire bare bedroom day trader. In the early 1990s, Wall Street was an exclusive domain, not easily accessible to outsiders. Business was thriving, but entry required not just skill but also prestigious credentials from top-tier institutions like Princeton, Harvard, or Stanford. Undeterred by the cutthroat environment, Kyle, armed with a shifted mindset, aspired to break into Wall Street, aiming for true financial freedom at any cost. Kyle Bass, the American investor and founder of Conservation Equity Management, a Texas-based private equity firm focused on environmental sustainability. He is also the founder and principal of Heyman Capital Management, LP, a Dallas-based hedge fund focused on global events. In 2008, Bass successfully predicted and effectively bet against the U.S. subprime mortgage crisis by purchasing credit default swaps on subprime securities, which, in turn, increased in value when the real estate bubble burst. In the beginning, everything was distinctly unusual. This wasn't the conventional start of an American dream tale with a white picket fence. Instead, it commenced with Kyle relying on prescription pills, even though he didn't actually require them. The root of this unconventional medication regimen lay in his mother's hypochondria and self-diagnosis expertise, akin to a medical infomercial evangelist. In an attempt to secure her son's well-being, she initiated a medication routine that inadvertently led Kyle to gain weight. Growing up in a lower middle-class environment where the family's financial struggles were evident in hand-me-down clothes and a daily dose of medication, Kyle's childhood set him apart from his peers. Fortunately, his father's role as a hotel manager in Miami offered a lifeline when the family relocated to Dallas, Texas, following a change in hotel ownership. Adjusting to a new environment, Kyle found himself yearning for change. And change he did bring about. Kyle defied the odds by discovering a passion for diving in Dallas, an interest that later laid the foundation for his success in trading. His relentless work ethic in diving earned him a scholarship, but despite his achievements in this arena, college failed to captivate him. The mundane subjects of chemistry, molecules, and anatomy left him yawning, pushing him to seek solace in the waters whenever possible. As he approached his junior year, faced with the choice of an elective, Kyle opted for something more exhilarating. A class titled Options and Futures caught his eye, stirring his latent curiosity about money. This marked a turning point as he delved into the world of finance, mastering the basics of bonds, stocks, and options. Finance became the book of revelations for Kyle, the key to escaping the shackles of a paycheck-to-paycheck existence. With newfound knowledge and a burning desire for financial freedom, Kyle dared to make a drastic decision. He switched his major to finance with a focus on real estate, defying the expectations of his parents and risking their disapproval. This decision marked the beginning of Kyle's journey into the world of finance, setting him on a trajectory to Wall Street. Overcoming the initial obstacle of mindset, Kyle secured a position at Prudential Securities, where he underwent rigorous training. The year and a half spent at Prudential was a challenging yet invaluable experience, exposing Kyle to the intricacies of global trading. Recognizing the potential in hedge funds, Kyle seized an opportunity to explore this emerging industry, eventually earning an offer from Bear Stearns. With $2,500 in hand, Kyle embarked on a journey to Geneva, venturing into the world of hedge funds. His role at Bear Stearns began as a research analyst, delving into potential stocks and presenting his findings to a group of short sellers. Despite the grueling workload and long hours, Kyle's determination led him to excel, and he soon ascended to the position of senior managing director at the age of 28, making history at Bear Stearns. However, Kyle's thirst for greater achievements did not wane. With a burning desire to master finance and achieve financial freedom, he took a leap of faith. Risking everything he had built, Kyle founded his own firm, Heyman Capital Management LP, with $5 million of his own money and $28 million from investors. The pressure intensified as he faced challenges in building a reputation and managing other people's money. Launching a hedge fund proved to be an arduous journey, demanding a solid reputation. Kyle faced skepticism from investors due to his lack of iconic trades or historic performances. The pressure mounted as he struggled to maintain investor confidence, facing doubts about the sustainability of his fund. Undeterred, Kyle sought a game-changing trade that would not only save his firm, but also establish his reputation. In a moment of serendipity at a wedding in Spain, Kyle stumbled upon a conversation about synthetic CDOs, the catalyst for the 2007 housing market crash. Intrigued by the potential, he delved deeper into the complexities of these financial instruments, realizing the magnitude of the opportunity. Despite facing disbelief and resistance from investors, Kyle persevered, eventually identifying a fraudulent scheme at a California company named Quick Loan Funding. Armed with conviction, Kyle made the bold decision to short the housing market. Employing a risk-averse approach, he pitched the opportunity to investors based on low-risk, high-reward prospects. This strategic shift attracted more investors to his cause, enabling Heyman Capital to make a massive bet against the subprime mortgage market. As the trade unfolded, Kyle's team purchased credit default swaps, CDSs, against the subprime mortgage market, leading to substantial profits. The success of the trade not only saved his firm, but also garnered widespread recognition. Kyle testified as an expert witness before the U.S. House of Representatives and the Financial Crisis Inquiry Commission, solidifying his status as a financial maverick. Despite achieving monumental success, Kyle's journey was far from over. Motivated by a constant fear of inadequacy and a desire to prove skeptics wrong, he set his sights on the next big opportunity, the emerging markets of China and Japan. His research and analysis focused on predicting the financial landscape for the coming decade, showcasing Kyle's unwavering determination to stay ahead in the ever-evolving world of finance. As Kyle's story unfolds, the audience is left with a profound message about courage, resilience, and the pursuit of one's ambitions against all odds. His journey from a kid on medication to a Wall Street legend exemplifies the transformative power of determination and the ability to overcome challenges. The script reflects not just the financial acumen of Kyle Bass, but also the human spirit's capacity for growth and triumph in the face of adversity. Thank you for joining us on this extraordinary journey. We hope you found inspiration in the story of Kyle Bass, a true embodiment of tenacity and triumph. Remember to subscribe for more compelling content. See you in the next video.
City, this is Eric.
Give me Elliot.
City.
Hey, it's Will Emerson.
William, how are you?
I'm all right. How's the trouble and strife?
Busting my ass as always.
You see, that's why I tried to tell you, John. Why do you think I'm single?
I know you did.
The events that unfolded during and after the 2007 to 2008 financial crisis shed light on many fraudulent activities and conspiracies in stock markets worldwide.
Will continue on Wall Street.
Soaring gas prices, falling home prices, and rising unemployment.
It became evident that there were manipulations, insider trading, and other irregularities happening in share markets. Shares were being emptied, and a considerable amount of them were being sold off. Numerous such activities took place, and by the time auditors and regulators got wind of these issues, a significant amount of time had already passed. Despite the regulatory efforts, the stock market, even in today's scenario, is rife with rampant speculation and rule-breaking. In the midst of all these incidents, one trader has managed to stand out and break all the rules: Steve Cohen. He's not only made headlines, but has also earned not just millions, but billions in the bull and bear markets. Now, let's explore a trade that's garnered attention for its rule-breaking nature: the story of Steve Cohen's risky operations in the stock market. The narrative begins with Raj Rajaratnam, a highly known name on Wall Street. During the midst of the 2008 Lehman crisis, a handful of investigations were initiated against him. Federal agents were relentlessly pursuing Raj Rajaratnam, aiming to set an example that if anyone was engaged in insider trading or fraudulent activities, they would face consequences. Trading is not easy to escape once involved. Investigations were ongoing during this time, with federal agents interviewing prominent traders to determine their involvement. One name repeatedly came in conversations and discussions related to insider trading: Steve Cohen. Federal agents were perplexed, questioning why Steve Cohen's name consistently surfaced in connection with these activities. To understand Steve Cohen's story, we need to go back to his beginnings. Born in 1956 into a middle-class family in Long Island, New York, Cohen did not come from a wealthy background. Despite financial constraints, he showed a keen interest in finance from a young age. Fascinated by the markets, Cohen was sharp in academics, and he secured admission to a university in New York. While attending university, Cohen would read the Wall Street Journal every morning, determined to enhance his business skills. His passion for making money was evident from his childhood. After joining the workforce, Cohen engaged in two important activities. Firstly, he played poker, winning against friends and accumulating money. Secondly, he immersed himself in the financial world, driven by the desire to earn more. Cohen's financial aspirations led him to venture into the stock market. He combined his talents for speculation and gambling, amassing great wealth. However, there came a point when he realized that relying solely on speculation might not fulfill his ambitions. This realization changed everything for him. In 1978, at the age of 21, Steve Cohen decided to shift his focus from mere speculation to building a more substantial career in finance, a desire to achieve something greater. Steve Cohen, after graduating, joined a brokerage firm named Gruntle in New York. Despite the company's tarnished reputation due to alleged wrongdoings, Cohen utilized his skills to turn a profit. On his first day at Gruntle in 1978, Cohen earned a profit of $300,000, a significant amount at that time. But Cohen continued to refine his skills, eventually achieving extraordinary success. Within a span of a few years, he generated profits ranging from 60 to 80 crores in the volatile Wall Street market. His success was unmatched, leading to widespread speculation and curiosity about his trading strategies. The turning point came in 1985 when the Securities and Exchange Commission, the regulatory body, took notice of Cohen's activities. Despite skepticism in the market, Cohen's clear strategy involved options trading, and he was exceptionally skilled at managing risk and maximizing profits. When an attempt was made to investigate, it became evident that there was significant discrepancies. There comes a controversy. The SEC scrutinized his transactions and discovered many irregularities. Cass Cohen was engaged in insider trading, all while justifying his profits by claiming it was a result of skillful trading, which led to the regulator monitoring his transactions. The regulator claimed almost 70% success rates for his trades were based on gut feelings and insider trading. So, what was he really up to? Cohen was aware of an impending takeover of the electronics company RCA by General Electric. Anticipating a rise in RCA shares, he strategically acquired a substantial number of them. When the RCA shares indeed increased in value, he made an unexpected and successful investment, earning a profit of almost 140 crores. He boldly declared on Share Super that he had earned a profit of 140 crores, but when his skeptics asked for a verification through screenshots, he dismissed it as fake. Later, Cohen's lawmakers, who were strong in this case, received a big amount of money. However, Cohen got a clean chit in this situation, so whether he will always get a clean chit in the future remains doubtful. Moving forward, after 14 years of hard work and using insider information through his network, Cohen gradually transitioned from being a small trader to establishing himself as a prominent figure in the trading world as he was really ambitious. Despite being ambitious, his aspirations grew so much that satisfaction with millions was not enough for him. He aimed not for thousands or millions, but for billions. To achieve this, Cohen decided to open his own fund house and engage in trading. Before that, he had worked in Grantley, where he earned commissions but decided to leave. In 1992, he decided to take a leap of faith and started an electronics company named SAC Capital Advisors. The initials of the company came from his own name, Steve A. Cohen. Cohen initiated this venture with 170 crores and began fund management with a team of 9 people. They started making a mark in the fund management industry. Asset under management is a term used to describe the total market value of all the financial assets a company manages on behalf of its clients. Whenever they invested, the birth of a company's EOM, equity under management, occurred. As a result, Cohen's speed increased so rapidly that in 3 years, he raised his company's assets from 170 crores to a whopping 800 crores. Not only that, but every 2 years, SAC Capital, which was common at the time, witnessed a huge boost, reshaping the entire city market. The profits were soaring, and the new fund was on the verge of doubling. By 1999, the total capital had reached a staggering 8,000 crores, a huge jump from its initial 170 crores AUM. Cohen's company left the stock market questioning how such substantial wealth was accumulated in such a short time. The answer was simple. Cohen managed his entire venture not just with insider information, but also maintained transparency, operating seamlessly until 1999. As the story progressed, Cohen expanded his network, and with that, everything seemed to flourish. However, a twist awaited in the narrative. The era of computers had arrived, bringing with it increased transparency. Now, every detail could be monitored. People were curious about who was buying and selling, which stock was rising or falling. This transparency, facilitated by computers, prompted Cohen to question himself. He realized that to rise above normal traders, he needed to elevate his skills to a new level. He recognized that achieving such ease wouldn't be simple. It required special knowledge and the ability to decode patterns. Cohen devised specific criteria for selecting trades. For instance, if a president of a listed company stayed within the 300-meter range, you had a better chance of being selected by SAC Capital. As historical regulations diminished, Cohen decided to resign from the regulatory position. As a result, he was offered a package 4 times larger. Now, a vast network was being established, including company owners, ministers, presidents, and professionals from other big companies. Cohen had created an extensive network of traders to ensure that profit was the sole focus. By the year 2000, a new era had arrived, and by 2005 to 2006, Cohen had become a prominent figure in the world's richest individuals. His personal net worth had exceeded $10 billion. The team was doing exceptionally well, and a substantial amount of money was in circulation. Many such traders and investors making significant money were part of this phenomenon. Continuing with Cohen's journey, he started making significant moves. With abundant wealth at his disposal, he began purchasing yards, private jets, and large houses. However, Cohen's actions raised eyebrows among those who had been in the industry for a long time, and the SEC was doubtful about his capabilities from the beginning. In the middle of it all, SAC Capital faced a critical moment in 2006. A notice arrived at SAC Capital's office, alleging that Cohen had manipulated the market. The accusation was related to a stock named BioWhale, a Canadian drug manufacturing company, and Fairfax, a Canadian insurance company. Both had become subjects of insider trading. The allegations were submitted to SAC Capital, stating that false negative reports had affected the share prices and caused substantial losses to their network. The nightmarish situation escalated when the regulatory authorities kept a close watch on SAC Capital's managers. Despite the acquisition of insider information and the negative publicity, the acquisitions by SAC Capital cast a shadow of concern. Cohen was under scrutiny, and the regulatory authorities were keen on understanding how these people made money, what wrongdoings they were involved in, and whether any mental torture was being inflicted. The story took a turn when Cohen, alongside Matthew, a prominent trader at SAC Capital, took a keen interest in a drug named BAPI. It was anticipated that the release of this drug could cause havoc once it entered the market. Matthew and his team initiated discussions, and a confidential agreement was signed. The agreement ensured that all information discussed during the 2-hour phone conversation, which took place from an anonymous number, would never be publicly revealed. The situation got even more intriguing when discussions about the upcoming trials of the BAPI medicine unfolded. Dr. Matthews shared detailed information about the drug's trials, supplying Cohen with valuable insights. As the supply chain unfolded, the capital kept growing, and the astounding profit of 600 crores through long trades left everyone astonished. Matthew initially went long on this stock, but now his enthusiasm has grown even more to the extent that he considers making money by shorting the same stock. This sudden realization occurred because Matthew thought that since the drug in question had only around 50 million users, it wasn't necessary for everyone to have Sebel Plus. When information about the trial surfaced again, he shared it with the leaders, and they decided that action needed to be taken. Gradually, on July 20th, Matthew started dumping his stock and established a short position. The reality was that he already had information about BAPI's results. Through the entire short trade, he made 1,800 crores. Now, you see how extensive the quagmire of insider trading is. That's how all this information reaches insiders before it becomes public. The investigation had reached a point where the FBI is trying to figure out why and how they are involved in insider trading. In 2009, investigations into the FBI began, exposing SAC's business practices with considerable attention. This is because, for many years, no information had emerged against them. They are handling the situation aggressively this time, and serious efforts are being made to catch them. The focus is particularly on Cohen. as they have initiated full-blown employee insider trading. However, when the interviews began and regulators came in to conduct investigations, they started with junior traders. Junior traders are more vulnerable and can be easily exploited. As the investigation progressed, it eventually reached Cohen. Cohen is now being questioned by the FBI about the reasons and methods behind insider trading. In their pursuit, they've come across an individual named Jonathan Hollander, who worked on Albert Stone's, who was also associated with a supermarket chain. He constantly shared information about stock market prices, market trends, and trading strategies. Intrigued by his friend's success, an individual decided to audit monthly trades. He used to constantly inform them about all the stock market prices, what content is going on, how much material is there, what's happening, how it's going. Basically, what happened is that this man kept discussing with his friend and created some positions there. It's astonishing that he made substantial profits, around 50 to 60 crores, with the information he received before the quarterly results. When they started monthly trade audit, Cohen had created a system in his company that monthly trade orders would be internal within the company. The FBI had been instructed to keep an eye on every trade of SAC, but Cohen had not been caught yet because Cohen had created a system for himself. He did that for self-protection and asked the inside traders in his company that after the trade is over, they have to hang themselves out of time, rate it from 1 to 10, and write the complete logic in front. Whether technical analysis was applied, fundamental breakout occurred, volume breakout occurred, fundamental was applied, and so on. In this way, he had already created a predated record. He used to get a call with proof, so that if there's an investigation tomorrow, he can show that his traders did nothing. All they did was technical analysis. Now, along with the FBI, SEC was also behind him. In November 2010, a very big incident occurred. The Wall Street Journal, which is a very famous journal abroad, publishes an article that something big is going on behind the FBI. And in November 2010, a very big event happened. That something is going on behind the FBI. And now everyone thinks that the bubble is going to burst. The entire world of investigation gets caught up in this. Everywhere there is chaos, and it seems like now we're trapped, now nothing can happen. And then, in May 2011, Sydney and Dr. Matthew, who made money in the pharma company, was included in the US authorities' hit list. They smell something fishy. There's been some wrongdoing. They've been put out on the radar, and they need to be caught somehow. Information has been leaked from here in some way, and they need to be caught by any means. So, as part of the ongoing investigation, it's come to light that Matthew Maratoma, the individual involved in the pharma deal, had entered into a contract with Cohen sometime before the said activity. This suggests that prior to the decline in pharma stocks, Maratoma had likely conveyed insider information to Cohen, indicating his intention to engage in trading. But there was another contract between them, which caused Maratoma not to speak of all their inside business when he was finally caught. When Matthew Maratoma was taken into custody, he was immediately arrested because he confessed that, yes, I did insider trading, but he invoked the Fifth Amendment, seeking protection for himself, much to the surprise of those present. They had assumed that by pressuring him to implicate others, particularly mentioning Cohen in the investigation, he might receive a reduced sentence. However, they were bewildered as he steadfastly refused to name Cohen, and it appeared that his strategy was not aimed at diminishing his own punishment. Subsequently, there were rumors saying that Cohen might be covering all of his legal expenses and handling various contractual obligations. No matter what the cost, I'll cover it for you. But in August 2012, Matthew Maratoma got arrested for insider trading related to Bappy's case. Surprisingly, he never mentioned Cohen's name despite the FBI coming in. Everybody was shocked, thinking, why isn't he pointing fingers? It could help him. Investigators were also puzzled. Cohen realized that trouble could reach him any time. In 2013, he took matters into his own hands. He went to regulators and offered a hefty 3,000 crore penalty to settle his case on behalf of SAC Capital. Cohen understood playing games might not work, so he wanted a serious solution. However, the SEC didn't accept. They wanted to set an example after years of pursuit for all the fund managers worldwide, saying that if you cross us, you'll get caught eventually. The search for evidence continued. Finally, in 2008, they found an email against Cohen. Mike Steinberg, a big trader at SAC Capital, sent Business Figures quarterly results from his company's computer to Dell. The twist? These figures were sent before the official results, and the exact numbers were from Dell's computer. This trade made a profit of 15 crores. The SEC had the evidence, but His lawyers were given such hefty money, and Cohen's lawyers were so influential that they proved in court that Cohen only reads 10% of his emails, and he never read this email. But the SEC wanted to set a big example by revealing Cohen's inside business. Therefore, they thought, if they are successful, they will demand a bigger penalty. And they said, no, you have traded from your company, even if you're imaginary and not a culprit. A penalty of 7,000 crores is due. Basically, they wanted to somehow win this when they present such a huge number. 7,000 crores will make the opponent surrender. They thought that now he would bow down, but Cohen was not one of the losers. Nobody could do a thing against him, and he was calm and didn't even flinch. Then, to his advantage, the argument was made that he hadn't read the email, so the trade didn't happen. Not only that, he accepted the restrictions imposed on him, agreeing not to trade within that brand anymore. So, he established .72 asset management, and his earnings skyrocketed, surpassing what he earned from the 1990s to 2002.